Arey yaar, did you just look at your March salary slip and your heart literally skipped a beat? You were expecting your normal salary, but HR randomly deducted 15,000 rupees, maybe even 20,000 rupees extra as TDS. Why? Just because you missed that one annoying deadline to submit your investment proofs. Dekho, right now you probably feel like that money's gone forever, like you just donated your weekend plans and grocery budget to the government. But I have a secret for you. That money is not lost, and that HR deadline, it is a complete myth. Today, I'm going to show you exactly how to get every single rupee of that TDS back legally without ever having to beg your HR. Let's fix your salary. Okay, so picture this. It's mid-February, you're at your desk, you get a message from your HR, last reminder, submit your investment proofs by Friday or we will deduct TDS accordingly. And you think, haha, I'll do it tomorrow. Tomorrow becomes next week becomes, oh wait, it's March already. And then your March salary hits your account and it is noticeably smaller. Like wait, did they miscalculate something level smaller? You check the payslip, 18,000 rupees deducted as TDS when normally it's maybe 4,000 rupees. You stare at it, you feel your soul leave your body a little bit. If this is you, or if you're watching this before this happens to you, this video is going to save you a lot of money and a lot of stress. So please stick around. I'm Rohan and I spend way too much time thinking about how Indian salaried employees are quietly losing thousands of rupees every single year. Not because of bad investments, not because of stock market crashes, but simply because of missed paperwork deadlines. If you're someone who earns a salary, gets confused every February when HR sends those investment declaration emails, and genuinely doesn't know the difference between what happens to your TDS versus your actual tax liability, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Alright, let's get into it. First, let's be very clear about what's going on, because most people have this completely backwards. Here's what most people think happened. I missed the HR deadline, so now I've lost my tax savings forever. Nope, absolutely not. That is not how this works, and I'm going to show you exactly why with actual numbers. Here's the thing. Your employer, through your HR and payroll department, is legally required under the Income Tax Act to deduct TDS, tax deducted at source, from your salary every month. They are basically collecting tax on behalf of the government before the money even hits your account. Now, how do they know how much to deduct? They estimate your total income for the year, they estimate your total deductions, they calculate the net tax, and then they spread that deduction across 12 months. This is where your investment declaration, officially known as Form 12BB, comes in, whether you filled out a physical PDF or just uploaded receipts to your HR portal. Submitting Form 12BB with your PPF, your ALSS, or your HRE rent receipts was your way of telling your employer, hey, reduce my estimated taxable income by this much, so deduct less TDS every month. But when you miss that deadline, your employer had no choice. They had to assume you have zero deductions or only the basic standard deduction and deduct TDS accordingly. Especially in the last quarter, they front load the remaining tax. Let me make this very concrete. Let's say your CTC is 12 lakh rupees per annum. Your take home after all deductions is roughly 1 lakh rupees per month. Under the new tax regime, if your income is below 12 lakh 75,000 rupees, that's 12 lakh rupees plus the 75,000 standard deduction, you're actually effectively tax-free under Section 87A. But if you hadn't declared this correctly to your HR, if they assumed you're under the old regime with no deductions declared, they might calculate a tax liability of 25,000 to 35,000 rupees for the year. And if February and March are left, they cram that entire deduction in those 2 months. Suddenly, 2 months of 12,000 to 18,000 rupees extra TDS. Your salary goes from 82,000 rupees to 64,000 rupees. That's not a rounding error. That's your grocery budget, your EMI headroom, your weekend plans, all gone. Now, here's what most people don't realize in this moment. This money is not lost. It has simply gone to the government as advance tax. You are going to get it back, but only if you know what to do next. Can we talk about something for a second? When people miss the HR deadline, there's this very specific kind of financial panic that kicks in, and I think it's worth naming it. It sounds like this. I've already messed up, so the whole thing is ruined. I'll just not think about it and maybe file ITR sometime in July. This is, and I mean this respectfully, a very expensive form of procrastination. Because here's what actually happens. When you take that approach, you overpay TDS, fine, but then you also miss deductions you were legitimately entitled to. Then you delay your ITR, then you file at the last minute in July and make mistakes. Then maybe you even miss the July 31st deadline, which by the way remains unchanged for salaried individuals filing ITR 1 or ITR 2. This year, according to the Union Budget 2026 and KPMG's analysis, the ITR 1 and ITR 2 deadline stays July 31st, 2026 for AY 2026 to 2027. And then suddenly you've turned a 15,000 rupees TDS problem into a 15,000 rupees TDS problem plus a belated return fee plus interest under Section 234A. The psychology here is what I call the sunk cost spiral. You feel like the mistake already happened, so you stop being vigilant about the next steps. But the original mistake, missing the HR deadline, is actually the smallest financial damage in this whole chain. The bigger damage is the inaction that follows. So let's break that spiral right now. Here's exactly what you need to do. Step 1. Don't panic. Confirm what actually got deducted. Pull up your last payslip. Look at the TDS column. Compare it to previous months. If it's higher than usual, that's expected. That's not a penalty, that's not a fine. That's just your employer being conservative because they didn't have your declarations. The number you see is an advance payment toward your annual tax liability, nothing more. Step 2. Calculate your actual tax liability right now. Now you need to sit down and actually figure out what you should be paying. And this is where most people skip a critical step, choosing the right tax regime. Look, here's the reality of 2026. The new tax regime is the default regime. Your employer almost certainly put you in it unless you specifically requested the old regime in writing through your company's HR portal, a declaration form, or a simple email to payroll. Quick note, Form 10I is only for people with business or professional income. If you're purely salaried, you never file that form. You just inform HR or tick the relevant box in your ITR. Under the new tax regime for FY 2025-2026, the slabs look like this. Up to 4 lakh rupees, zero tax. 4 lakh rupees to 8 lakh rupees, 5%. 8 lakh rupees to 12 lakh rupees, 10%. 12 lakh rupees to 16 lakh rupees, 15%. 16 lakh rupees to 20 lakh rupees, 20%. 20 lakh rupees to 24 lakh rupees, 25%. Above 24 lakh rupees, 30%. And here's the magic. If your income is up to 12 lakh, the Section 87A rebate of 60,000 wipes out your entire tax liability. Add the 75,000 standard deduction for salaried employees, your effective tax-free income is 12.75 lakh under the new regime. 12.75 lakh tax-free. Let me say that again because I don't think people fully appreciate this. If you're a salaried person earning up to 12.75 lakh per year and you're in the new regime, your tax is zero. But if your HR deducted TDS because you didn't declare anything properly, you might have 20,000 to 30,000 rupees sitting with the government right now that is 100% yours to claim back. Now, you might be thinking, Rohan, what if my old regime deductions would save me more? Fair question. Let's do the math. The old regime is worth it if your actual deductions, Section 80C investments like PPF, ELSS, life insurance up to 1,50,000 rupees, Section 80D medical insurance up to 25,000 rupees, HRA if you're renting, home loan interest up to 2 lakh rupees under Section 24B add up to more than roughly 3,75,000 rupees in total deductions. Here's a quick example. You earn 15 lakh rupees per year. Under new regime, tax on 15 lakh minus 75,000 rupees standard deduction equals 14 lakh 25,000 rupees taxable. Step by step, 0 rupees to 4 lakh rupees, 0 rupees, 4 lakh rupees to 8 lakh rupees, 5% of 4 lakh rupees equals 20,000 rupees, 8 lakh rupees to 12 lakh rupees, 10% of 4 lakh rupees equals 40,000 rupees, 12 lakh rupees to 14.25 lakh rupees, 15% of 2.25 lakh rupees equals 33,750 rupees. Base tax 93,750 rupees. Add 4% health and education cess, total 97,500 rupees. Under old regime, 15 lakh rupees minus 50,000 rupees standard deduction,
Old regime gets 50,000 rupees, not 75,000 rupees. Important difference. Minus 1,50,000 rupees ATC, minus 25,000 rupees ATD, minus 1,80,000 rupees HRA equals 10,95,000 rupees taxable. Step by step, 0 rupees to 2,50,000 rupees, 0 rupees, 2,50,000 rupees to 5 lakh rupees, 5% of 2.5 lakh rupees equals 12,500 rupees, 5 lakh rupees to 10 lakh rupees, 20% of 5 lakh rupees equals 1 lakh rupees, 10 lakh rupees to 10.95 lakh rupees, 30% of 95,000 rupees equals 28,500 rupees. Base tax 1,41,000 rupees. Add 4% cess, total 1,46,640 rupees. New regime wins by 49,140 rupees, not 8,600 rupees, 49,140 rupees. And look, I know that surprises people, including me honestly, the first time I ran this properly, but this is exactly why you need to actually do the math and not just go with gut feeling or old regime feels safer. At 15 lakh rupees with standard deductions, the new regime is not just convenient, it is significantly cheaper. And the gap only narrows if you're maxing out every single deduction category, including a big home loan claim under Section 24B. This is where it gets really interesting. Most people who insist on the old regime assume it must be saving them money, but they've never actually run the numbers slab by slab, and they're often not maxing out their ATC either. So they are paying extra tax in the name of saving tax while simultaneously not making the investments that would even partially justify it. That is a beautiful, expensive contradiction that I see constantly. Step 3. Gather every proof you have. Investment proofs, rent receipts, insurance premium receipts, LIC premium statements, PPF passbook, ELSS statements, whatever regime you're going with, organize everything. Here's the thing that nobody tells you. Even though your employer's deadline has passed, you can still claim every single legitimate deduction when you file your ITR. Your employer cannot claim deductions for you anymore, but the income tax department, they are waiting for your ITR till July 31st. Every deduction you legitimately made during FY 2025-2026, April 2025 to March 2026, you can claim. The HR deadline is your employer's internal deadline. It is not the tax department's deadline. This is genuinely the most misunderstood thing in Indian personal finance, and it drives me a little crazy, honestly. Step 4. Check if you still have last-minute investment opportunities. It's March. March 31st, 2026 is the final date for any investments that count for this financial year. If you haven't made your 500 rupees minimum deposit to your PPF account, do it today. If you were planning to buy a term insurance policy, the premium paid before March 31st, 2026 counts. ELSS mutual fund investments can be done in minutes on any platform right now. I'm not saying panic buy bad products, but if you were going to make these investments anyway and just hadn't gotten around to it, today is the day. According to the Income Tax India compliance calendar, March 15th, 2026 was the deadline for advance tax, but for investment purposes under ATC, ATD, etc., March 31st, 2026 is your absolute last date. Step 5. File your ITR accurately and file on time. This is the step where you get your money back. When you file your ITR 1, if you're a salaried person with income from one employer and maybe savings interest, or ITR 2 if you have capital gains, two employers, etc., you enter your gross income from Form 16. Your employer will give you this. All your deductions, this is where you put in everything HR missed, TDS already deducted, pre-filled from your Form 26 AS and AIS. The system then calculates your actual tax liability. If TDS deducted is greater than actual tax, the difference shows up as a refund. The income tax department typically processes refunds within 20 to 45 days for straightforward salaried returns filed online. And with the new Income Tax Act 2025 taking effect from April 1st, 2026, the compliance process is actually being streamlined. CBDT is actively working to make ITR processing faster. Small important note here, the new Income Tax Act 2025 does not change tax rates or deductions. The slabs, the ATC limit, the 87A rebate, all the same. It's essentially a restructuring and simplification of the old 1961 Act. So don't let anyone confuse you on that front.
All right, this is where I want to get a little philosophical with you. There's a cultural conditioning in India, and this isn't just a tax thing, this is a broader money thing, where we treat getting money back from the government as somehow a bonus, like it's a gift. It's not. It's your money. When your employer deducted 18,000 rupees extra TDS from your March salary, that 18,000 rupees went to the government as an advance. If your actual tax liability is 4,000 rupees for the month, the remaining 14,000 rupees belongs to you. Legally, factually, the government owes you money. Now, here's a shocking statistic for you. According to the latest CBDT data, as on February 2026, over 3,34,000 crore rupees in refunds have already been processed in FY 2025 to 2026. That number sounds huge, but it also means an enormous number of people were overpaying their taxes in the first place. And how many people just don't file or file incorrectly and leave money on the table? The CBDT reported over 8.8 crore ITRs filed for AY 2025 to 2026, which means there are still millions of people who either don't file, file late, or file incorrectly. Every one of those people potentially left their own money with the government. Now you might be thinking, okay, Rohan, the refund amount might be a few thousand. Is it even worth the effort of filing correctly? Let me put it this way. If I told you there was 15,000 rupees in a locker with your name on it and all you had to do was fill out a form online for about 25 minutes, would you do it? Of course you would. That's exactly what filing your ITR correctly is. Except the locker is the income tax e-filing portal, the form is ITR 1, and the 25 minutes is probably generous. I mean, getting a haircut takes longer. Quick, rapid fire. Things people do wrong in this situation. Mistake number 1. Randomly changing tax regime at ITR time without calculating. Salaried employees can choose their regime at the time of ITR filing, but think carefully. Don't just go with the new regime because it's simpler if your old regime deductions genuinely make you better off. Run the actual numbers. Use the income tax calculator on incometax.gov.in. It's free, it's updated, and it does the math for you. Mistake number 2. Ignoring Form 26AS and AIS. Before you file, download your annual information statement from the IT portal. It shows all TDS deducted on your behalf, from salary, from FDs, from anything. If there's a mismatch between what your employer shows and what 26AS shows, reconcile it before filing. Mismatches are the number one cause of ITR processing delays and notices. Mistake number 3. Not declaring small interest income. Your savings bank account interest, your FD interest, your liquid mutual fund short-term capital gains, your savings bank account interest, your FD interest, your liquid mutual fund short-term capital gains. All of this needs to be declared even if it seems small. Two things to keep clean here. The TDS threshold under Section 194A is 40,000 rupees per year for regular taxpayers, 50,000 rupees for senior citizens. That's the point at which banks deduct TDS on FD interest. But that TDS threshold is completely separate from your deductions limits. On the deduction side, under the old regime, Section 80 TTA gives you up to 10,000 rupees deduction on savings account interest only, not FDs, available to non-senior citizens. Section 80 TTB gives senior citizens 60 plus 50,000 rupees on savings account plus FD and RD interest, and it replaces 80 TTA. You can't claim both. Neither of these sections exists in the new regime. But here's the point: regardless of regime, all interest income must be declared, even if it's covered by 87A. The government can see every rupee in your AIS. Don't play games with it. Mistake number 4. Waiting until the last week of July. Every year, the income tax portal slows to a crawl in the last 10 days of July. File in May or June. Your Form 16 will be ready by June 15th at the latest. There is zero reason to wait. Filing early means faster refund processing and way less stress. Look, missed deadlines happen to everyone. Life gets busy, March is chaotic, HR emails get buried. I get it, but here's what separates people who are actually financially healthy from people who just feel like they are managing: the follow through. The follow through after the mistake, the discipline to not spiral, the clarity to know that this is fixable, the math works in your favor, and the money is literally waiting for you. Here's your action list before you close this video. Check your March payslip. Know exactly what was deducted. Decide your tax regime, new versus old, with actual math, not guesswork. Make any remaining investments before March 31st, 2026. PPF, ELSS, insurance, NPS, whatever makes sense for your situation. Collect all proofs even if HR won't accept them anymore. The IT department will when you file your ITR. File your ITR on time. ITR 1 and ITR 2 deadline is July 31st, 2026. Aim for June. Track your refund. It'll come. And when it does, invest it. Don't spend it. That's a whole other video. The Indian tax system is genuinely complex and confusing. I'll never say otherwise. But it's not designed to trap you. Most of the time, the confusion costs you more than the tax itself. So, you miss the HR deadline? Okay, now what? Now you file a correct ITR. You claim every deduction you're entitled to. You get your refund, and next year, you set a calendar reminder in November, December, and January so this doesn't happen again. You've got this. If this video helped you understand what to do next, please share it with at least one colleague who I guarantee is in the exact same situation and has no idea what to do. That's genuinely the best way to support this channel. I'll see you in the next one.